Welcome, my friends. The news today is that Fitch has warned that it may be forced to downgrade dozens of banks, including JP Morgan Chase. Fitch Ratings cut its assessment of the banking industry's health in June, a move that analyst Chris Wolfe said went largely unnoticed because it didn't trigger downgrades on banks. But another one-notch downgrade of the industry's score from AA to A+ would force Fitch to reevaluate ratings on each of the more than 70 U.S. banks it covers, Wolfe said. If we were to move it to A+, then that would recalibrate all our financial measures and would probably translate into negative rating actions, Wolfe said. If you follow this channel, you know that Moody's Analytics has already cut ratings of 10 U.S. banks and put some big names on downgrade watch. Among the smaller lenders receiving an official ratings downgrade were M&T Bank, Pinnacle Financial, Bach Financial and Webster Financial. Major lenders Bank of New York Mellon, U.S. Bancorp, State Street, Truist Financial, Cullen/Frost Bankers and Northern Trust are now under review for a potential downgrade. Banking turmoil is taking another step up. You probably recall that, just a couple of weeks ago, Heartland Tri-State of Elkhart, Kansas has failed and was sent into receivership by the Federal Deposit Insurance Corporation, FDIC. As you probably recall, a number of banks have failed so far in 2023. Silicon Valley Bank, Signature Bank, First Republic Bank, Silvergate Bank voluntarily shut down and went out of business. And Pacific West Bancorp was forced to merge with Bank of California just last week. What does it mean for the economy? And, what does it mean for the future of the United States? But, before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. A Fitch Ratings analyst warned that the U.S. banking industry has inched closer to another source of turbulence, the risk of sweeping rating downgrades on dozens of U.S. banks that could even include the likes of JP Morgan Chase. The ratings agency cut its assessment of the industry's health in June, a move that analyst Chris Wolfe said went largely unnoticed because it didn't trigger downgrades on banks. But another one-notch downgrade of the industry's score, to A+ from AA, would force Fitch to reevaluate ratings on each of the more than 70 U.S. banks it covers, Wolfe said in an exclusive interview at the firm's New York headquarters. If we were to move it to A+, then that would recalibrate all our financial measures and would probably translate into negative rating actions, Wolfe said. The credit rating firms relied upon by bond investors have roiled markets lately with their actions. Last week, Moody's downgraded 10 small and mid-sized banks and warned that cuts could come for another 17 lenders, including larger institutions like Truist and U.S. Bank. Earlier this month, Fitch downgraded the U.S. long-term credit rating because of political dysfunction and growing debt loads, a move that was derided by business leaders including JP Morgan CEO Jamie Dimon. This time, Fitch is intent on signaling to the market that bank downgrades, while not a foregone conclusion, are a real risk, said Wolfe. The firm's June action took the industry's operating environment score to AA from AA because of pressure on the country's credit rating, regulatory gaps exposed by the March regional bank failures and uncertainty around interest rates. The problem created by another downgrade to A+ is that the industry's score would then be lower than some of its top-rated lenders. The country's two largest banks by assets, JP Morgan and Bank of America, would likely be cut to A+ from AA in this scenario, since banks can't be rated higher than the environment in which they operate. And if top institutions like JP Morgan are cut, then Fitch would be forced to at least consider downgrades on all their peers' ratings, according to Wolfe. That could potentially push some weaker lenders closer to non-investment grade status. Shares of lenders including JP Morgan, Bank of America and Citigroup dipped Tuesday amid broader market declines. The KBW Bank Index also fell. For instance, Miami Lakes Florida-based Bank United, at BBB, is already at the lower bounds of what investors consider investment grade. If the firm, which has a negative outlook, falls another notch, it would be perilously close to a non-investment grade rating. Wolfe said he didn't want to speculate on the timing of this potential move or its impact on lower-rated firms. We'd have some decisions to make, both on an absolute and relative basis, Wolf said. On an absolute basis, there might be some BBB banks where we've already discounted a lot of things and maybe they could hold on to their rating. JP Morgan declined to comment for this article, while Bank of America and Bank United didn't immediately respond to messages seeking comment. In terms of what could push Fitch to downgrade the industry, the biggest factor is the path of interest rates determined by the Federal Reserve. Some market forecasters have said the Fed may already be done raising rates and could cut them next year, but that isn't a foregone conclusion. Higher rates for longer than expected would pressure the industry's profit margins. What we don't know is, where does the Fed stop? Because that is going to be a very important input into what it means for the banking system, he said. A related issue is if the industry's loan defaults rise beyond what Fitch considers a historically normal level of losses, said Wolf. Defaults tend to rise in a rate hiking environment, and Fitch has expressed concern on the impact of office loan defaults on smaller banks. The impact of such broad downgrades is hard to predict. In the wake of the recent Moody's cuts, Morgan Stanley analysts said that downgraded banks would have to pay investors more to buy their bonds, which further compresses profit margins. They even expressed concerns some banks could get locked out of debt markets entirely. Downgrades could also trigger unwelcome provisions in lending agreements or other complex contracts. It's not inevitable that it goes down, Wolf said. We could be at AA for the next 10 years. But if it goes down, there will be consequences. Moody's cut the credit ratings of a host of small and mid-sized U.S. banks a couple of weeks ago and placed several big Wall Street names on negative review. The firm lowered the ratings of 10 banks by one rung, while major lenders Bank of New York Mellon, U.S. Bancorp, State Street, Truist Financial, Cullen/Frost Bankers and Northern Trust are now under review for a potential downgrade. Moody's also changed its outlook to negative for 11 banks, including Capital One, Citizens Financial, and Fifth Third Bancorp. Among the smaller lenders receiving an official ratings downgrade were M&T Bank, Pinnacle Financial, Bach Financial and Webster Financial. U.S. banks continue to contend with interest rate and asset liability management, ALM, risks with implications for liquidity and capital, as the wind down of unconventional monetary policy drains system-wide deposits and higher interest rates depress the value of fixed-rate assets, Moody's analysts Jill Satina and Anna Arsov said in the accompanying research note. Meanwhile, many banks' Q2 results showed growing profitability pressures that will reduce their ability to generate internal capital. This comes as a mild U.S. recession is on the horizon for early 2024 and asset quality looks set to decline from solid but unsustainable levels, with particular risks in some banks' commercial real estate, CRE, portfolios. Regional U.S. banks were thrust into the spotlight earlier this year after the collapse of Silicon Valley Bank and Signature Bank triggered a run on deposits across the sector. The panic eventually spread to Europe and resulted in the emergency rescue of Swiss giant Credit Suisse by domestic rival UBS. Though authorities went to great lengths to restore confidence, Moody's warned that banks with substantial unrealized losses that are not captured by their regulatory capital ratios may still be susceptible to sudden losses of market or consumer confidence in a high interest rate environment. The Federal Reserve in July lifted its benchmark borrowing rate to a 5.25%-5.5% range, having tightened monetary policy aggressively over the past year and a half in a bid to rein in sky-high inflation. We expect banks' ALM risks to be exacerbated by the significant increase in the Federal Reserve's policy rate as well as the ongoing reduction in banking system reserves at the Fed and, relatedly, deposits because of ongoing QT, Moody's said in the report. Interest rates are likely to remain higher for longer until inflation returns to within the Fed's target range and, as noted earlier, longer-term U.S. interest rates also are moving higher because of multiple factors, which will put further pressure on banks' fixed-rate assets. Regional banks are at a greater risk since they have comparatively low regulatory capital, Moody's noted, adding that institutions with a higher share of fixed-rate assets on the balance sheet are more constrained in terms of profitability and ability to grow capital and continue lending. Risks may be more pronounced if the U.S. enters a recession, which we expect will happen in early 2024, because asset quality will worsen and increase the potential for capital erosion, the analysts added. Though the stress on U.S. banks has mostly been concentrated in funding and interest rate risk resulting from monetary policy tightening, Moody's warned that a worsening in asset quality is on the horizon. We continue to expect a mild recession in early 2024, and given the funding strains on the U.S. banking sector, there will likely be a tightening of credit conditions and rising loan losses for U.S. banks, the agency said. The failures of Silicon Valley Bank and Signature Bank in March were the third and fourth biggest ever. The recent closures of First Republic, Silicon Valley Bank and Signature Bank this year have shaken up the banking industry, prompting lawmakers to introduce new legislation to protect customer deposits and stabilize the financial system. You probably recall the dramatic collapse of Silicon Valley Bank in March that triggered days of chaos in the U.S. banking system. On July 25, PacWest merged with Banc of California, with both banks seemingly looking to shore up amidst the banking industry turmoil. The Federal Reserve increased its benchmark rate over the past year to more than 5.25% in July, the highest rate since 2007, in an effort to curb inflation in the country. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.